Hey everybody, it's Dr. Schick back again talking finances today. I previously unveiled my debt investment hierarchy ladder here. Today we're going to plan on doing a deep dive on our bottom rung, the stocks and bonds. So here we go. So stocks and bonds, why they're the bottom on my ladder, there's higher risk because you need to know a lot more to invest in these things. So essentially when you buy a stock, you're buying a share. A share is like a pizza pie, so you're buying one little piece of the pizza pie. If the pizza grows, meaning the company does well, your slice of the pizza gets bigger, meaning you get more money. There's generally speaking two types of stocks. There's common and preferred. Common stocks, you get voting rights. Preferred stocks, you get higher dividends typically. So more money coming in routinely, more voting rights. So pick your poison there. Bonds, typically bonds, there's three main types. There's government, corporate, and municipal. Government bonds typically fund public works. Corporate bonds typically come with a higher interest rate, but there's more risk there. And then municipal bonds are through your cities more often than not, and those tend to be tax-exempt interests. How a bond works is that you're paid a yield. The yield is a reimbursement of your entire principal plus some interest. So when you do a bond, it's basically a loan. You're giving this place some money and they're promising to pay it back with interest. Again, that's the yield. A lot of risk investing in individual stocks and bonds. That's why I do not recommend these for regular dentists. So we're going to continue our talk going up my investment hierarchy ladder today. Previously, we talked about the lowest ladder rung, and that's the stocks and bonds. Today, we're going to move up a ladder and talk mutual funds. So essentially, mutual funds are big pools of money from various investors that are they're getting lumped together. That money is being managed, keyword, being managed by professionals. So in quotes, I had professionals because sometimes they're not so professional. Now, typically, when they do this, they're buying a diversified group of assets. So they can buy stocks, they can buy bonds, they can buy stocks and bonds. So inherently, when you're lumping a bunch of stuff together, you're decreasing your personal risk through diversification. So that is why these are better than stocks and bonds. Going back to they're being managed by professionals, you incur a fee when that is done. That fee is known as your expense ratio. So some companies like Vanguard are known for assets that have very low expense ratios, while other companies you'll see very high expense ratios. So when you're looking at investing in a mutual fund, you should know what the expense ratio is. You don't have to take my word for all this stuff. There's an accounting master, a financial expert, Burton Malkiel. He wrote this book. I've read this thing like 5 times. I got notes all over this thing, but A Random Walk on Wall Street. So if you want to learn a lot about mutual funds, this is the best book I've read that talks about basically just mutual funds. So here we go. Index and sector funds were created in the 1970s. They were created by John Bogle. He's the one that kind of invented Vanguard. He created them in response to the high fees associated with mutual funds. So he found that many mutual funds had very high expense ratios. The fees were just too high. He in fact has a famous quote, I wrote it down here, that says, "The road to investment failure is paved by expensive advice, expensive instruments, and expensive advertising to make you buy." So what he was getting at is everyone wants to pay to have their investment, where the less you spend to get the investment, the more you can put into the investment, and therefore the more money you can make. So basically why index funds and sector funds have lower fees is there's no active management going on. In index is basically you can index anything. So there's an index of the best 500 companies in the United States of America. For Vanguard, that's ticker VOO. There's that for the best 300 companies in the world, VTI. Since they're not putting things in and out, there's no actual movement, there's lower fees. So lower fees because there isn't a manager and there are no transaction costs moving things in and out of the index. Likewise with sector funds, you're just doing a sector, healthcare, technology, computer chips, whatever it might be. And again, they're not moving things in and out, so much lower fees. So by buying index and sector funds, you're inherently getting diversification through pooled assets, but you're not paying for active management. Hence John Bogle's advice. Here are 2 great books I've read. This is kind of a more old school book. If you really love finances, this is a good one for you. But if you're not super into finances, a little dry. And then this is a good one, a little bit more recent, the Boglehead's Guide to Investing. It does dive pretty deep, but I think these are both tremendous books to start out on. Just as a reminder, the higher you go up the ladder, typically the lower effort and lower risk on your part. Today we climbed all the way up to target date funds. Let's dive right in. So target date funds are kind of like a special savings account that you have a known date, and they're basically there to help you reach that goal. So how it would work is you'd pick a goal date. So for me, let's just say we're talking about retirement. I want to retire by 2050. So I would select target date fund with a maturation date of 2050. And the beauty of this is no effort on your part. You invest, you can dollar cost average, and invest routinely into this. And as it starts, if you have a long time frame, 20 or more years, it's going to have an asset allocation, meaning primarily focused on stocks. That way you have a higher chance to get some good gains over time. As the account ages, you get closer to that retirement date, it's going to allocate the assets for you and shift to a more bond-focused investment portfolio. That decreases your risk and means that you're hopefully not going to lose a lot of money at the end. So why I like these, it does all that hard work of asset allocation for you. Now, when you reach your end date, I used to think you just had to sell these things off. That's not necessarily the case. You can either sell some of it, live off the dividends from the account itself, or just transfer it to an IRA. I haven't had to do any of those steps, but that would be the next step. One downside is these do have some degree of active management, hence the asset allocation. So there is a managerial fee typically associated with that, but it's a well worth it fee in my mind because they're doing all this asset allocation for you as the account ages. And that's really worth its weight in gold. I left the book at work, but a book I read about this, I Will Teach You to Be Rich by Ramit Sethi. He dives deep into target date funds and he finds them as a tremendous investment vehicle. So if you're looking for something very hands-off, just pick a date that you want to retire, be putting money into it and leave your brain off, target date funds are an excellent option for dentists. So I really like these. Finishing up our discussion of the dental investment hierarchy ladder, we've climbed our way all the way to the top, the retirement account. So let's dive right in. So available to dentists, there's typically two main types. There's an IRA, individual retirement account. There's also 401ks, which are employer-sponsored retirement account. Typically how this works is you contribute pre-tax earnings into the fund. So what that means is before the company disperses the money to you, they would take this money, put it in the 401k account, and that would be your pre-tax money. Now, when you take that money out in retirement, you do have to pay taxes on it, with the idea being you're in a much higher tax bracket today than you will be at retirement because you're earning money today. So that's how you can save money. A workaround is the Roth 401k, Roth IRA. That's after tax contributions. So you've already paid taxes on the money going in, so you don't pay taxes when it comes out on the backside. Additionally, with these, especially the employer one, the 401k, sometimes there's a match option. The match is a fancy way of saying if you put 3% of your salary in, they're going to match that. So literally, this is free money. So any match criteria that's offered to you, you should always max that out. Additionally, you might hear about like 401k limits. So every year you can put in a maximum. I believe for 2024, it was $23,000 for an individual. Now you could put $23,000 in and your employer could put $23,000 in. So people get a little confused. The match means that you also can double your contribution amount. So by all means, dump money into the match if you got it, which is why I've got it at the very top of my investment hierarchy. If you are offered a match, it's free money, it's free investments, and you need to jump on that. Now that we've climbed all the way to the top of the ladder, Dave Ramsey likes retirement accounts, so I put his book out there for this one. Let me know what you think. Do you agree? Should retirement accounts be the main area that dentists are putting their money in? Or is it somewhere else? Let me know what you think. And as always, stay drilling, my friends.